Hello viewers, the Parabolic SAR, the SAR standing for stop and reverse, is a very powerful technical indicator used in the charts, works across all markets, time frames, like I said, very popular. But what I can see is that it's often misunderstood, misused, and the inputs can seem confusing to some. So in this video I'm going to take a deep dive into the PSAR, that's Parabolic SAR for short, and I'm going to pull it to pieces, see what it's made up of, look into its history, see how we can apply it into markets and time frames. And if you stick around, I will throw it out there, some strategy ideas for you as well, so you can piece it all together and put it together in your own trading. So with that, let's get started. So first of all though, I want to show you this book. It's called New Concepts in Technical Trading Systems by J. Wells Wilder Jr. Published in 1978. There's only a few of these copies left. You might be lucky enough to scrape one off of Amazon. But this guy, you know, J. Wells Wilder, he's like the godfather, or one of the godfathers of technical analysis. And if you just open up the contents and see some of the systems that he produced, other than the parabolic, we've got the volatility index. I'm just going down the contents here, and system, the directional moving concept and system, momentum, relative strength index, reaction trend system, swing index, the commodity selection index, you know, capital management. It was a great book and start in the world of technical analysis. And if you are lucky enough to get your hands on it, you'll see that, you know, it's done in the old-fashioned way. You know, even when I started in the 90s, people were drawing charts by hand. You know, there's these calculations there, and we can see even he's laid out the rules on the pages. You know, it's a great book. It's one of those books that I started learning technical analysis from back in the day. But it defines actually what the Parabolic SAR is all about. Today, you know, it's taken on many derivative forms. It's been developed and changed, but we're going to go back to the core elements of the PSAR, and like I said, pull it to bits and then put it into today's world of trading. So, you know, by going back, it explains it in much more simpler terms, and then, like I said, you can then choose to develop it and tweak it further. Like I said, those inputs, why are the inputs like they are? Let's find out by going back to the root. So with that, now let's jump into the Parabolic SAR. So here we go. Got an example in front of you to make it a bit clearer to start with. This is on the S&P 500 futures. It's a daily chart. Now remember, Wells Wilder back in the day didn't have the well, he had the limitations that we don't, of being able, you know, we can access intraday data. He was more focused on daily data. So I'm going to start from that point of view to begin with. And you're looking at the chart here now, and you see those white dots on there. Well, that's the PSAR in action. And some of you might be thinking, well, actually, it looks a bit like a moving average that's not joined up. But the difference here between that and the moving average is that the PSAR is looking at extreme highs and lows, and then applying some sort of acceleration factor. The formula there is slightly different. We look at that in a minute, but essentially each one of those dots are the SAR part of the equation, stop and reverse. So each one of those is a potential stop and reverse point. The parabolic comes from, you know, the shape that the dots produce, a bit like a parabolic curve. So putting it together, parabolic stop and reverse. So like I said, each one of those points is a potential, has the potential to reverse from where it is. Now, dots under the price data, that's a bullish trend, and dots above the price data, that's a bearish trend, as you can clearly see there in some of those examples. Let's just draw it on. Look, there's a bearish Parabolic SAR set up. There's more of a bullish one there because it's below the data. So let's have a look at the formula first. So those of you good at programming or want to understand how it works, then this is how, you know, the nuts and bolts get put together. Note also the bullish, the up PSAR has a slightly different formula to the bearish PSAR, so bear that in mind. And I've called it the UpSAR and the DPSAR, as you can see there. And the UpSAR equals a prior PSAR plus prior AF in brackets, then prior EP minus prior PSAR, and then the slight change for the down bearish trend there. So we want to know what those variables stand for, so let's get into those. So the UpSAR, that's the bullish up PSAR. The AF is the acceleration factor. Now I'm going to talk about these numbers in a bit more detail after this, but we're just going to get into, like I said, the formula at the moment. Now it starts at 0.02 and increases by 0.02 up to a maximum of 0.2. Now these were the initial numbers that Wells Wilder put into his machine, and we'll explain what they mean in a bit. Can we vary them? What numbers should we be using? Like I said, we're going to find out. And each time the extreme point makes a new low, that's a bearish SAR, or high bullish SAR. And the DP SAR, that's the bearish down SAR. The EP is the extreme point, and that's the lowest low in the current downtrend, D SAR, or the highest high in the current uptrend, U SAR. So that's the formula. So let's get back to the charts and look at those variables in a bit more detail. Now back to our S&P 500 daily example with the PSAR added on. Where can we first of all find it? Now this is a trading view chart. You can go up to indicators at the top. If you just type in parabolic, there it is, and you can see all, like we're talking about, derivatives and strategies around the parabolic. Like I said, very popular indicator, but you just click on the Parbolic SAR and it'll add it to the chart. Now I've slightly amended the settings slightly. Let's go into those, double click on there. So the style, I've just changed them to dots on trading view. They come up more as crosses. I've changed the colour to make it a bit easier, and then we go to our inputs. This is what we're talking about. These are the key variables. It can start at 0.02, and here we go up an increment of 0.02 to a max value. Now what did Wells Wilder actually say about it? Well, he'd done his own back testing back in 1978 and found that, or before, and found that these numbers worked best for him overall. Remember, this is before software and the computer revolution, so it's easier to backtest and change these numbers, but this is what worked for him. And he did have some rules in there, so he said no problem optimizing the numbers that he's put in there, but he said the range for the incremental increase should always be between 0.18 and 0.018 and 0.021, and any constant increase within this range will work well. He says use the number of increases it takes to reach at least 0.20, but do not exceed 0.22. So that's his rules, but like I said, you can play around as much as you like. I normally keep them as standard, but experiment, change them around, change the increments, the max values, the start numbers, and see what effect it has. And I always say back test and check out the data, the results that you get before committing any funds to your strategy. Don't back fit, make it look like a great tool. I like to go and try it out on multiple markets, time frames, see what results I get, see if I get similar results, and then I can build from there. And like I said, this is on the daily chart, and what Wells Wilder didn't have was this sort of functionality where we could very quickly change it by time frame. So we could change our S&P to maybe a 3-hour time frame, and you can see it quickly redraw. We can even go down to like 5 minutes and lower, really up to you. Remember the inputs and how they're created. We're looking for the trends and then that stop and reverse point. So what is it exactly telling us then? Well, like I said, each one of these dots is a potential stop and reverse point within that trend. Now, when we see this switch from the bullish to the bearish, then that's our signal to change direction. It's creating buy and sell signals for us. So when the dots move from one side to the other, that is our either buy or sell signal. Other traders, what do they use it for? Well, you could quite easily use it as like a trailing stop type approach. Follow up your trade until you get taken out of the trend when it switches over. So I'd say the main two uses for it, from what I can see, is that it's creating buy and sell signals itself, or you can use it as like a trade management, risk management tool that helps you with your stop loss management. You can actually see down here how the PSAR is trailing behind, but notice even when the price starts to go flat, we're still getting these more aggressive dots, and that's due to the calculation, those different steps and increments we put in. Finally, it's like a catching up of the actual price. It finally catches it up, and then it switches to the bearish direction. Now, for me, it has a few weaknesses. One is obviously when we get the more the sideways moving markets, and also the fact that we're constantly getting signals in here. Now, from my back tests, on its own, the PSAR is good, but I think really you need to add other indicators on top of it to increase the probability of success here, because you're going to get a lot of poor quality signals chopped that we don't want. So we've got to filter those out, and I think that's best if you, like say, add further indicators on top, to improve the quality of the trend and that reversal signal that it's giving us. And I suppose another annoying point to it could be where you see in this example, we got this nice trend here, and because we've got aggressive, we've got the standard setup, we then get a flip to get us out the trade, and then while the trend continues on upwards, and it's a similar thing here, just two dots there, but actually the trend continues. So think about your trade management here, building maybe, like I said, other indicators, and you might have a moving average under there that keeps you in the trade, and maybe you pull up your stop loss to a certain point, you use another parameter, or you stay in the trade while you're still above this, and you add trades every time you get this reversal. So you add on to the initial one, so you keep that initial one going, then you've got the second trade in there, and then the third trade to finish. And maybe when it cuts down through the trend there, that longer term moving average that you might have on it, or other indicators that you put on down below, when it's broken that set of rules, then you get out of the trade. So I'll say that's a little bit annoying, because sometimes you do see like these little hot spots of cutting you out on a decent uptrend. Or maybe another consideration, let's just remove those drawings, you could maybe even flick it to a Heikin-Ashi type chart, although you can still see even then you've got these cutouts against the trend direction there. You can see there and there. And I will show you in other videos, you could switch maybe to my favourite charts, Renko again, which sort of iron out the blips a bit more and create a different viewpoint, but you're still going to get them. And again, it's a case of building rules around what you're doing, back testing the results, and going with what you eventually qualitatively work out as the right way forward for your trading. So using it, putting together strategies, let's take a look. Sticking with the S&P 500 again. In TradingView, like I said, they've got a lot of strategies already pre-built by users of TradingView in there, but they also have the default Parabolic SAR strategy. As you can see there, it's got a back test to it. So let's just see what sort of numbers we would get on the S&P 500 daily, and as you can see there, if we'd have used that exclusively on its own, it's not looking a great picture, is it? We're down overall over the period of that back test. Let's just quickly see how far I've gone back here. Wow, to 1997. That's a really long back test. Using standard settings, like I said, the chart, but here you'd probably do the flip of it to make any money. The drawdown as well, quite hefty, around 17%. But that doesn't mean it doesn't work. Find the markets, you know, don't backfit it, but find the markets it does work on. Find the time frames it does work on. But just by quickly changing the time frames, we can see whether we improve the results or not. It's just spinning through the calculations, and actually it did improve it, but not by much by the 3 hours. Take it down to 1 hour. Does it help? Well, we start to get positive now, so it's looking better in the shorter term. But remember what I said in the previous section, using it just on its own, you know, you're getting about 40%, you know, late 30% win rate here. So your trade management, another reason for the poor performance could be the trade management rules you set up. Maybe the signals are good, but maybe you've got to take maybe a percentage gain, maybe 1.5% risk reward, for, you know, for every 1% you risk, maybe, or an ATR type stop loss, you know, trailing stops, all those sort of things could improve your results. And if you wanted to, in like TradingView, you can mess around with those numbers to see whether they do improve your results. But key rule there, don't backfit. Let's just take it down to 5 minutes there on the S&P. Again, flat, sort of going nowhere. So on its own, it's not looking great on the S&P 500. And just to show you it does work, we've got soybeans here, soybean futures. Yeah, the curve isn't the greatest there in the back test at the bottom, but you know, it's 1,500% over the lifetime of the back test. Notice again, even when it works, low percent profitable, nearly 40%. So that's looking like a key number, and it's a pretty hefty drawdown there. So my advice is add other indicators on top to improve the percent profitable, the win rate, and come up with more creative trade management, you know, stop loss strategies to improve the results further. Let's have a quick play before we wrap things up, just adding on a few indicators and what I would maybe add on. So here we've got a 4-hour Bitcoin chart from Binance. That's the data set. You can see our Parbolic SAR on there, the white dots, and all I've done simply here is add on a RSI, standard RSI, but I'm not going to use it in its traditional overbought, oversold ways. Now, by doing this over the back test, put the winning trades up to about 70% with a much better net profit factor. Did slightly increase the drawdown compared to, say, if I was using a moving average trend system, but still 70% win rate, and that could be improved maybe further, or the actual overall returns you improve further by, like I said, implementing different trade management rules around the stop loss, maybe using ATR stop loss, you know, fixed profit targets like 1.5%, 2%, try those sort of things. But as you can see here, all that I'm doing here is when we get the flip from, say, a negative downtrend to a bullish one, I want the RSI to be greater than the 50, the midline there, so indicating a bullish trend about to occur with that switch from, like I said, under 50 to over 50. And it's the same with the vice versa. So when we get this signal up here, as you can see, we're still above 50 in there, so we would not take that. So that ignores that trade. And remember earlier I was talking about maybe building something that can keep you in longer for more trades. We'll maybe have a think about that. Add on a big long-term moving average onto this as well and see if that improves results. But you know, just by adding on the RSI indicator and using that plus minus 50 rule, you've taken it from 40% probability up to nearly 70%. Now remember, this is on Bitcoin, so it could be different on different markets. You've got to do your own back testing, but it's just an example of how you can improve the power of the PSAR. So there you go, the parabolic stop and reverse indicator. Hopefully that's given you the background you need to, take what you've learned here and take that into your own trading. Maybe play around with the inputs, the variables, add on, take away other indicators, create your own strategies, do the back test, do the hard work, and then come out with a highly effective strategy. Let me know in the comments whether you use the PSAR. Let me know what sort of success you've had with it. Interested to hear your ideas and thoughts on that one as well. If you liked today's video, please give us a thumbs up. Don't forget to hit the subscribe and bell buttons to receive further notification of such content. It all helps the channel. And coming up now, a couple of playlists for you to help you in your trading education and journey. In both, work your way from the top to the bottom and you'll come out the other side hopefully a much better trader, and they're coming up right now.